Hello and welcome to this YouTube channel for ACCA FR exam prep. My name is Adam. In this video, I will be taking you through how to account for financial liability measured at amortized cost. Now let's look at the question. Again, it's an extract from a full past question. So to ensure that you understand the very measurement for financial liability at amortized cost. So P&L information, financial position information, all of these in the trial balance. So we have trial balance relates to Quincy year end 30th September 2014. And in this trial balance, we have loan note interest paid. This is 1.5 million. Then we have 6% loan note, 25 million. What you do is to cross-check to see if all the interest was paid in the year. So this is 25,000 times 6%. So 25,000 times 6%, that should give you 1,500 or 1.5. It means that all the interest was paid. If all the interest was not paid, it means portion will become a liability, current liability. Now, the additional information. Quincy issued 25 million 6% loan note on 1st October 2013. Again, if you reconcile this to the year end, that should give you 12 months. Very important to note that. Issue costs were 1 million, and these have been charged to administrative expenses. Interest is paid annually on 30th September each year. The loan note will be redeemed on 30th September 2016 at a premium which gives an effective interest rate on the loan of 8%. So this will become the finance cost interest. Now, what are the details? In measuring these, we have to look at on the date of 1st October 2013. What should be the valuation? Which again we say initial measurement. The initial measurement as per the standard IFRS 9, it should be fair value. And the fair value should be the proceeds or how much was received. Proceeds. So here the proceeds was 25. They issued it at 25. So 25. So let's say 25 million. So 25 million. Less issue costs. And the issue cost was 1 million. So this should give us a fair value of 24 million. But look at what happened. The entity charged the issue cost to P&L as part of administrative expenses, and that is incorrect. So it means that in the P&L, we have to do an adjustment. An adjustment would be that at the year end, so 30th September 2014, it means we will have to debit. I'll show you what to debit and we'll credit. Now, the debit should go against the loan note because the loan note itself is already a credit item. So the debit will be 1 million. And we have to go to P&L and reverse these treatment. So we'll credit the admin, so administrative expenses. So we are removing it from admin expenses, 1 million, to reverse the error. So this will give us the reversal. So we have been able to reverse reversal of error. Now, again at the year end, this loan note will be carried at the amortized cost. So we say loan amortization or the amortized cost. So we have the year end, which is 30th September 2014. We have the opening balance, which will be the fair value, that will be 24. So let's say all of these are in thousands, that will be 24,000. I have the finance cost, which will be based on the effective interest of 8%, and I have the interest paid because it's a liability, and that will be based on the 6%, and that was given in the question to be 1.5, and that's a deduction. And we'll have the closing balance. So let's see the effective interest. So 24 times 8%, that will be 1920. So 1920 plus 24,000 minus 1,500, that should give us 24,420. So it means that on the phase of the P&L, so the financial statement impact, so in a P&L, this is what we're going to be doing. As part of the admin expenses, we will deduct the issue costs. So the 1 million becomes a positive in the P&L because we are deducting it from admin expenses. And then we bring the finance cost. And the finance cost is the effective, which is 1920. And this is an expense. Now, in the statement of financial position, also in thousands, we are going to have, as part of the non-current liability, the 6% loan notes, and that is the closing balance, which is 24,420. So this will be the presentation in P&L and in the financial position statement. So remember that issue costs are not to be expensed. As per the standard IFRS 9, the issue costs would have to be deducted from the proceeds received on the issue. So they are not to be expensed. And if they are expensed, you have to reverse it. So the issue cost deducted at the initial measurement will give us this fair value of 24 million. I hope this helps you in your preparation for the FI exam. Please subscribe to the channel to receive updates on new videos.